Hello? Right, so welcome to the live stream today, and sorry for the late start. I mean, we have some issues here that we had to deal with. That's why I'm starting too late. I see some of you guys joining on YouTube as well as on Facebook. Comment in the chat box any questions you have for me. And for those of you on YouTube, sorry, who are with me on the chat here on Zoom, you indicate by raising your hand, and then if you have any questions, then I can take you through. And for those of you on Zoom, be mindful that we are streaming on Facebook as well as on YouTube. So just telling you about that. So if you have any questions, you indicate by raising your hand, I'll call you, then you put up your question, or you can also put it in the chat in Zoom, then I can take your questions in that case. So welcome. We want to go straight up into our discussion. Facebook, I see some of you guys coming up. Let's see feedback here. So Facebook, I see some of you guys also joining. You are welcome. Share the video and let's reach many students on the live stream. Okay. So as indicated, what I want to do today is to answer some questions that you're having and provide you with some understanding on the various things that you need to look out for corporate reporting as well as for financial reporting, and sharing with you some core issues about the financial reporting standards with some attention on IAS 37, provisions, contingent liabilities, IAS 33, intangible earnings per share, IFRS 15, revenue from contract with customers, and then IAS 12, income tax. So let me share my screen with you, then we'll begin the discussion there real quick. I see some of you guys coming up. If there are any questions, you put it in the chat. For those of you with me on Zoom, you indicate by raising your hand, then I'll bring you up on the chat so that you come with your questions in that case. Or if you don't want to talk also, you could put it in the comment section. So let me bring up my screen and let's get going. Okay, so Mohammed Said Suleiman on YouTube said, you are welcome, sir. Thank you, Mohammed. Mohammed said, please brief us on diluted earnings per share. Okay, so that is IAS 33. I mean, it's one of the issues that I have in my mind. So let me share my screen and let's get into the discussion real quick. Coming up. Let's see. Bringing up my screen in a moment. I don't know, my screen also not sharing. Let's see. What the heck? Let's see if I can reshare. Okay, so we up. Let's go. So earnings per share, IAS 33. Mohammed's question was for me to share my thoughts on diluted earnings per share. I see some of you guys joining on Facebook, on YouTube. If there are any questions, put it in the chat, put it in the comment, and I'll be answering all of your questions for you. In that case, Maswell, Girage, I see you. Or what? Girasha, something like that. Maxwell, I see you. You are welcome. Comment in the chat box any questions you have for me. Mohammed is asking a question about diluted earnings per share. That is IAS 33. Now, when it comes to IAS 33 earnings per share, it's divided into two. In that situation, we have what we call the basic earnings per share. It's divided into two, and then the diluted earnings per share. The basic earnings per share refers to what exactly is happening currently within the year on the various earnings that shareholders are going to be having. Now, what is going to happen is that when it comes to the basic earnings per share, three things there. We have the issue at full market price. We have the bonus issue. And then we have the right issue. We have the right issue. Now, when it comes to the diluted earnings per share, also there are two things in that case. Diluted EPS. We have what is called the convertible low notes, issue of convertible low notes. And then we have the share options. We have the share options. So the question coming in from Mohammed is for me to focus and share my thoughts on the diluted earnings per share. So I'm going to go straight up into the diluted earnings per share and talk about it. Now, the diluted earnings per share has to do with the hypothetical earnings per share. In other words, the earnings per share that the entity is going to be having due to some changes that are going to be happening in the future. And the first one is share option that I want to share with you is share options. Now, share options are incentive schemes that organizations give to management for them to work or fulfill a certain condition within the organization. Now, for those of you who are doing corporate reporting, I mean, you know about share option already under IFRS 2, share-based payment. But for those of you in financial reporting, you will be doing that later on in level 3 corporate reporting. But share option is just a right we are giving to the management of the organization or the employees of the organization for them to have the right to buy shares within the company, and then most importantly, for them to be able to become shareholders in the company. However, when it comes to dealing with share option, what's going to happen is that we are going to assume that these shares are going to be converted today. Now, what is going to happen is that at the date that we gave them that option is referred to as the grant date. So at that date, we are going to determine what should be the value at which they are going to be buying the shares. Now, chances are, not chances, almost always, the exercise price, that is the price at which they will be buying the shares, will always be less than the current share price of the company. Will always be less than the share price of the company. So what is going to happen there is that there is going to be some dilution in there. So we are going to assume that these people will buy their shares today. Would they definitely buy it? We don't know. Is it time for them to buy? No, sir. But we are just assuming and saying that, okay, what will happen to the earnings currently should the share option be exercised by the employees or by the management of the organization? That is the idea about share option. Now, in dealing with share option, yes, we know our diluted earnings per share is going to be a profit attributable to equity shareholders divided by the weighted average number of equity shares. Note that share option has no impact on the income statement or on the profit for the year, so there will not be any adjustments to the profit or loss or profit attributable to equity shareholders. So there will be no adjustment. However, when it comes to dealing with the weighted average number of equity shares, that one would have to be calculated. So the weighings to be calculated. So whilst the entity will not be able to, or while there will not be any adjustment on the profit for the year, the weighted average number of equity shares is going to be subject to change in that case. So how do we calculate the weighted average number of equity shares? The way we calculate the weighted average number of equity shares is to go through 3 steps. So the step 1 is to calculate what we call the percentage of dilution. The percentage of dilution. Now, the percentage of dilution is simply going to be equal to the share price of the company minus the exercise price, that is the price at which they are going to be buying the shares, divided by share option, divided by the share price, sorry, multiplied by 100, because the percentage of dilution, it's always going to be by 100. Then 2, you calculate the number of shares in the option. You calculate the number of shares in the option. The way you calculate the number of shares in the option is simply the percentage of dilution in step 1, percentage of dilution in step 1, multiplied by the share option. So in the question, the examiner will give you a share option of 100 million shares, a share option of 200 million shares, a share option of 10,000 shares. So whatever number of share option that is given to you, no P, all you do is you calculate, or you bring that up and multiply that by your share option that you computed in the step 1. Then step 3, you can now calculate the weighted average number of equity shares. So the way you deal with the weighted average number of equity share is simply to bring the outstanding shares during the year. You bring the outstanding shares, then you add it to the number of shares in the option as you computed in step 2. So number of shares in option as you computed in the step 2. So that is the idea about how you deal with the diluted earnings per share when dealing with the issue about share option. Share option. So the only issue here is knowing how to calculate the weighted average number of equity shares, and the 3 steps is what has to be in your head when it comes to dealing with the share options. The second thing about diluted earnings per share is to talk about the issue in relation to convertible low notes. Convertible low notes. Now, when it comes to convertible loan note, there is a dedicated standard for this, IFRS 9 financial instruments for that. But that is not what we're dealing with here. We are just looking at the earnings per share aspect of it. Now, what are convertible loan notes? As the name suggests, convertible loan notes simply are loan notes which give the holders the right to convert the loan into equity shares on the date of redemption. So when it is time to redeem, they can decide, we want our money or we want shares. What we want to do in this thing is that we want to ask, okay, what will be the impact on the earnings should these convertible loan note holders convert into shares? So we want to tell shareholders, hey, if today you may be making an earning of, say, 75 cents per share, but what if these people convert into their shares? The share will go up, and then your earnings could be diluted in that particular situation. So that is the idea about how we deal with the convertible loan note. Again, we're going to be assuming that these people are converting their shares today. Is it time for them to convert? No, sir. Will they convert? We don't know. But we are going to pretend, we're going to assume hypothetically and say that what will happen to the earnings if these people convert? So again, our diluted earnings per share is going to be equal to the profit attributable to equity shareholders over the weighted average number of equity shares. But the truth of the matter is that convertible loan note has an effect on their profit. So we need to make an adjustment to the profit for the year. Why is that? The reason is that since we are going to assume that they are converting today, it means whatever interest payable to them will not be paid. So the interest will be added back to the profit. But you know that interest is tax deductible. For that reason, the tax benefits that we would have had as a result of payment of the interest, we won't get that as well. So that is going to be deducted in that case. So we are going to be adjusting the profit after tax for the interest and the tax benefits. Then we will definitely have to also calculate the weighted average number of equity shares. So that is the idea there. Now, how do you adjust? Very simple. So adjustment of the part. Adjustment of profit after tax. All you do is to bring the, let's work with two cash columns. All you do is to bring the profit for the year as given to you in the question. Then you bring the interest payment on the loan notes. We will no longer pay that. So the tax benefit of that will be taken out. Now the tax benefit is simply your interest multiplied by the tax rate. Okay? You take that out and we get an interest net of tax. That will be added up. So meaning that here, your profit after tax adjusted, it's going to go up. Profit after tax adjusted is going to go up. So that is how we adjust our profit figure when we are dealing with convertible loan notes. Then from there, you can now calculate the weights. The way you calculate the weights is simply to say that your weights will be equal to the outstanding shares plus the number of shares in convertible loan notes. The number of shares in convertible loan notes. That is the idea there. Now, how do you get a number of shares in convertible loan notes? Very simple. For instance, they can say that every $1,000 bond will be for maybe 200 shares. So if you realize that the loan note is 10 million, you just do your mathematics and then you'll be able to get a number of shares in that case. So when it comes to dealing with diluted earnings per share, that is how you go about it. I see some of you guys joining on YouTube as well as on Facebook. You are welcome. Comment in the chat box with any questions that you have. For those of you who are with me here on Zoom, you can indicate by raising your hand. And if you have any questions for me to look at, or you have any question for me to answer, you can raise your hand. I'll bring you on, or you can put it in the chat, or in Zoom, or in the Zoom call in the chat, and I could read that for you as well and answer that there. So Mohammed Nazif, that is your question in that case. Let's see. This is what you're saying. Let's see what, yeah, Martin, I think your hand is up on Zoom. You can come with your question.
Yeah, Nhyira, yeah. How do you differentiate this convertible loan note from the IFRS 9 convertible loan note over there?
Dealing with earnings per share, convertible loan notes, this is the treatment. Dealing with earnings per share. But what is in IFRS 9 is a whole thing altogether about how you recognize it and the subsequent measurements. So IFRS 9 gives you description about the initial measurement, the subsequent measurement, and then the disclosure requirement for financial instruments. And convertible loan note is one of the financial instruments. But in IAS 33, All you are dealing with is how many shares are you getting from that loan note, and not necessarily how it is accounted for, because the way the loan note should be accounted for will be dealt with in accordance with IAS 30, IFRS 9. So that is what you need to understand there.
No, I know, but what I'm asking is that in the footnote, how do you differentiate whether this is IFRS 9 or this is this belong to diluted earning per share?
If in the footnote the examiner asks you to calculate diluted earnings per share, and in the footnote there is a convertible low note, then you have to do this. But if the examiner doesn't ask you to calculate diluted earnings per share, and there is convertible low note in the footnote, then you account for it in accordance with IFRS 9. Does it make sense? Okay. All right. Then someone said, what? How many times is provision for unrealized profit supposed to be treated in console? I see three treatments, and I'm confused. Parent selling to sub. I don't know what you mean by you see three treatments. Provision for unrealized profit treatment, it's very simple. If a parent is selling to the subsidiary and you have provision for unrealized profits, that provision for unrealized profit, the double entry is you have to debit the group retained earnings since you said the parent is the one selling, or you debit cost of sales. You debit group retained earnings if you are preparing the consolidated statement of financial position. You debit cost of sales if you are preparing the consolidated statement of profit or loss. That's it. Then the credit entry goes into inventory. You deduct that from the inventory. That is if you are preparing the statement of financial position. That is the treatment for provision for unrealized profits. So I don't know what you meant by three treatments and what you mean by you are confused. But from the scenario that you just mentioned, if a parent is selling into subsidiary, that will be the treatment for provision for unrealized profit. Any other questions, you put it in the chat on YouTube, you put it in the comment section on Facebook. Then for those of you who are with me on the Zoom call, you comment or raise your hand and I'll bring you up with any questions that you have in that case. Yes, Osmano.
Nhyira,
Yeah.
I think that of 2020 console. Now, when I was working with the unrealized profits, no, the parents sold the goods to the subsidiary. But the way they calculated the profits, unrealized profits on the goods sold, I'm not getting it well.
If you say the way they calculated it, what exactly do you mean?
So, I'm coming. They said the parents made sales to Paradise throughout the year, and it had consistently been 600 per month. Kino had markup of 25 on all these sales. How they
Which
get it?
exam date did you say you are solving?
Is a
Which exam date did you say you are solving?
that is number 4 rather.
So what is your concern here?
the 1.2 and the markup on it is my problem now.
Who is selling to who?
The parent is selling to the subsidiary, that is the kingdom, to paradise.
So what do you think is supposed to be done as compared to what was done? Tell me what you think you are supposed to have done.
I thought now the 6,002, that is the 1,200 is with the paradise. So that is the total selling price. So I have to convert this 25 from markup to the selling price. That is how, as soon as I see it, then it came into my mind. But they went there and made it 25 over 125 times the 1,002.
Okay, so listen. Kingdom Limited made sales to Paradise Limited through the year, and it's consistently been 600 per month. Kingdom made a markup of 25% on all these sales, a total sales of 1.2 at cost to Paradise. If that is at cost to Paradise, then that means that it is the selling price to Kingdom. So it means that you have sales here and you are giving markup. Do you understand that?
Yes.
Do you understand that?
Yeah.
So it is sales, it is cost to Paradise, the one buying, but that is the selling price from the one selling. So if that is the scenario, I mean, you could go with your KG2 approach that selling price is cost price plus profit, whatever it is. Then you're going to have the 1,200, the cost we don't know, 0.25x, 1,200, 1.25x. So that x will become 1,200 over 1.25. What do we have? 1,200 divided by 1.25. That's 960. That's the cost. So that the provision for unrealized profit is going to be 1,200 by 960. And that's 240. Is that what they had?
Yes.
Do you understand?
Yeah. I get. What's at a point in time, then what do you think will also be changed? All right.
No. Listen. If you remember when I was teaching you on realized profit and those things, I made a statement. I told you that always look at the value from the perspective of the one selling, not from the perspective of the one buying, because you will determine the markup or margin effect from the perspective of the one selling. In this case, Kingdom is selling to Paradise. So, and I gave this illustration when I was teaching you that if, for instance, it is cost to the one selling, then that becomes the selling price. So always look at it from the perspective of the one buying. I think what you did was 25% of the 1,002. Is that what you did when you were solving?
Yes.
That is not it. Because the 1,002, if it had said cost to Kingdom, you get the idea? If it had said cost to Kingdom, then what you have done will be correct. But because it says cost to Paradise, in the books of Paradise, the one buying, that is the cost of those goods. But you have to look at it from the perspective of the one selling. So if that is a cost to Paradise, then it becomes selling price to Kingdom. So that is the idea. Always look at it from the perspective of the one selling. So it doesn't matter what the examiner says. Always ask yourself, the one selling, is that the cost figure or the selling price? The one selling, is it the cost figure or the selling price? That's the idea. That's the idea.
Okay.
Right. So any other questions? For those of you who are joining on Zoom, raise your hand and I'll bring you up with any questions you have. For those of you joining us on YouTube and Facebook also, put it in the chat box. I'm reading all your comments as well. And we'll be bringing you up in that situation if there are any questions you have for me that you want me to share my thoughts on. Timothy Ahas, I believe that I have answered that question already. Then I'm seeing a question coming in on YouTube. Please, can you help me with this one? Cassava has accounted for a fully subscribed right issue. If equity shares made on 1st April of the new issue for every 4 at 20 Ghana pesos, the company paid ordinary dividend of 3 Ghana per share on and on this. The dividend payments are included in administrative expenses in the trial balance, which is 25,000. Equity per the trial balance of this. Okay, I mean, I cannot get this question actually coming up. Like I can't get a context of it. In the trial balance, what was the equity? Is it indicating that they have already recorded the right issue or not? Now, because I don't have that information given to me, I could just comment on the dividend. The dividend that has been paid, what's going to happen is that they have included in it in administrative expenses, but dividend is not part of administrative expenses. So the total dividend of 25,000, which has been paid, will be deducted from the administrative expenses. In that case, then what is going to happen is that it will rather be deducted from the retained earnings in the statement of changes in equity. So if you ask me about how you deal with the dividend issue, then that is what you need to know about. Like I said, I don't know the equity shares in the trial balance. You just said 25 Ghana pesos for 61,000. So I don't know if they had already recorded it or they hadn't recorded, because if they had already recorded, the treatment will be different. If they have not, the treatment will be different. So Dosom, Adomasom John, I don't know if I mentioned your name right. If you can clarify that for me in the chat, in the comments box on YouTube, sorry, on Facebook, I can answer that for you better in that case. Johnny Walker said, even though I'm not writing any exams and following the teaching and enjoying it, I hope to take up my ICA whenever I return to Ghana. All right, that is great, John Walker. Wishing you all the best. I see some of you guys joining on YouTube as well. Comment in the chat box any questions you have. Osmanu, your hand is up again, or is the old one?
So, please, on that same question, item number 3, the policy of Kingdom Group Limited is to value all properties to fair value at each year end. On 31st December 2019, the increase in Kingdom property had been recorded. However, a further increase in 1.2 million in the Paradise property since its value at acquisition has not been yet recorded. So my question here is that when you are determining the goodwill, will this thing be part of the subsidiaries, what do you call it, net assets?
So let's get a context well in that situation. The policy of Kingdom Limited Group is to value all properties at fair value at each year end. On 31st December 2021, the increase in Kingdom's limited property has already been recorded. However, a further increase of 1.2 in the value of Paradise Limited's property since its value at acquisition to 31st December has not been recorded. Yes, so that is going to be revaluation of assets at the end of the year. Revaluation of asset at the end of the year. So that 1,002 will come to the net asset schedule at the end of the year. But you got to be careful, because revaluation will, if you bring it in the net asset schedule, that 1,002 will be included in the post-acquisition profit. But that revaluation gain of 1,002 is not profit. So before you determine the post-acquisition profit, that 1,002 will have to be deducted from the post-acquisition profit. I don't know if you got that.
Yeah. That is what they did. And in fact, I was finding it difficult to get the whole thing.
That is it. Because share of profit, revaluation surplus is not part of the profit the company made. So even though in our net asset schedule at the year end, it will be an addition there, you will not include it in the sharing of the profits. And that is very tricky if you don't really get that in the treatment. So that is the idea about that.
To trick us like that.
It's not a trick. It's about understanding how the treatment is.
Nhyira.
Yes, sir.
Yeah. Nhyira, it means that
Martin, today your network is not good.
Subtract that amount from yeah.
If I heard you said it means we will subtract that amount from the profit. Yes. So the post-acquisition profit.
I'm having the post-acquisition profit.
Yes. So the post-acquisition profit figure you will get, whatever. If it is 4,000, you need to less that revaluation surplus, 1,002 from it, so that you will now get 3,008-ish, 2,800. That becomes the post-acquisition profit that you will share between non-controlling interest and then the controlling interest. So that will be the treatment there. That will be the treatment there.
Sir.
Yes.
So in a situation where you are asked to prepare the income statement and the financial position, so which of these profits do you take it?
Easy. When you are dealing with the statement of profit or loss, this 1,002 would have gone to OCI because that's an other comprehensive income concept. It won't be in your P&L because you know revaluation gain always goes to the OCI in that situation. It is in the statement of financial position that 1,002 has to be added to the PPEs in the consolidated statement of financial position. So that's the treatment on that.
So my question is that you prepare the net asset at reporting dates at acquisition and also at reporting. Now the profit that you get there, then when you are going to prepare the for consolidation profit and loss, you pick that of the parents and the subsidiary and add them together. So how will you end that particular, because you have already calculated the profit at the end? So
no. When you are dealing with the P&L accounts, dealing with the profits, it's going to be different. If you are dealing with a P&L account, when you get a group result, you need to look at the profits attributable to the shareholder, NCI. So if you are looking at the profit attributable to the shareholders, you are not going to include that revaluation of assets. If you could do that working separately, you would just bring the profit for the year of the subsidiary. Then whatever fair value adjustment you did for the period will be deducted or added back, whatever it is. And that is what gives you the post-acquisition profit. It is on this post-acquisition profit that you will take NCI share, which is what you deduct from the group results so that you get the profit attributable to the controlling interest. That's the idea.
Okay.
That's the idea.
Yeah. That's it.
Okay. Rachel said, Nhyira, how do you treat borrowing costs capitalized when the qualifying asset is funded by both specific funds and general funds? So you just find out your weighted average cost of capital and how much of the specific fund. So let's say that for illustrative purposes, let's say that the cost of the asset is maybe $10 million. Okay, the cost of the asset is $10 million. Let's say that we borrowed, how much did we borrow? Let's say we borrowed $8 million. Then the rest of the $2 million is coming from the general funds. $2 million. If this is what you are trying to say, we will just find out, okay, what is the interest rate here? What is the interest rate there? And calculate the weighted average interest rate. And then you will calculate your borrowing cost in that situation and bring your weighted average rate on the 10 million, and that will give you the interest rate that you are supposed to capitalize in that case. The rest of the general borrowing, the finance cost on that would have to go to the P&L in that case. So the rest of that will go to the P&L, because only the parts that we use for the assets will be capitalized, and then the other portion of general funds will be written off in the P&L account. So if you asked about how you treat borrowing cost capitalization of qualifying assets when funds is coming from both specific and general, that is how you go about it. All right. Mate Ago Mensa said, how do I join on Zoom? Oh, today's Zoom session is not available. It's just our students who are available to join the Zoom session. So to join us on the Zoom. So if you have any questions, you can put it in the chat, and I'm going to read all your comments. Ellie on Facebook, I see you with a thumbs up. Thank you for joining us. Dosom said, please, in the trial balance, shares is 20 KP. Okay, so my question, John, my question is, in that trial balance with that 20 GP 61,000, have they included there that note something? Like, is it referring to the note that you read? The reason I'm asking this is that I want to know if it has already been recorded or not. Because if it is recorded, the treatment is going to be different. If it is not recorded, the treatment is going to be different in calculating the number of shares. So is there any note in the trial balance indicating that the equity shares, like into brackets notes, whatever note number you gave me, is there anything like that? If there is nothing like that, then we'll take this as the opening shares and then do the computation on that. So please clarify that for me, and let me see if I can share my thoughts on it real quick. So the profit that is ascertained in P&L for controlling interest, where do we take it? Where do you take it? Because we calculate, you don't take it anywhere. You don't do anything with it. The profit that you calculate in the P&L account, you don't do anything with it. It is the post-acquisition profit figure that you calculated is what you are going to be dealing with in that case. So the profit for NCI and P&L, you don't do anything with it, because if you are preparing the position, you will get the post-acquisition profit and share between CI and NCI. So what goes on in the P&L account goes on in the P&L account, and it doesn't end up anywhere in the statement of financial position. Let's see. Henry Annan said, hi, please, which certification is best for career progression for an MBA finance graduate? ACC or ICA? I mean, they are all good courses. They are all professional courses in that case, but ACCA is a global certificate, whilst ICA, on the other hand, it's jurisdictional, that is in Ghana in that case. So if you want to sign financial statements and in Ghana, then you have to be an ICA person, but you can also be a global person, because ACCA is a global certificate. So whether ACC or ICA, they are all good areas to go into. The only issue is one is global, one is jurisdictional in that case. So if you have an ACCA, you cannot sign financial statements in Ghana. You need to have an ICA to be able to sign financial statements in Ghana in that case, because ACCA is global, ICAG is jurisdictional for Ghana. So that is the idea there, Henry Annan. Okay, so John is saying nothing like that. Okay, so if nothing like that, then you need to find the number of shares that you are having in that situation. So if you look at it per the figure, you are saying 61,000 divided by 0.25. That's the nominal value, so that you can get a number of shares. So 61,000 divided by 0.25, I'm getting 244,000 shares. So it is from this 244,000 shares. It is from this 244,000 shares that the company is making a right issue. So let's see. On 1st April, they made an issue of one new share for every 4 shares. So 1 for every 4. So number of shares in the right issue is going to be in the right issue. They said 1 for 4, so it will be 1 over 4 times 244,000. So 1/4 for 244. That's going to be 61,000 shares. Now that has to be splitted into the new shares for everyone for share at 30 shares. So that is the new issue coming up, and that is on 1st April. So they said that the company paid a dividend of 3 Ghana pesos per share on 30th November and 5 Ghana pesos per share on 31st May. What is our year ended? Oh, I don't like this. What's our year ended? I don't know the year ended, so we know how we could pick the items up. What's the year ended? Let me know the year ended so we could know what exactly we would do. So if you get a value here, that's going to be 61,000 shares times 20 cents, 0.25, sorry, 0.20, 61,000 times 0.2, and that's 12,200 Ghana cedis. So let me know the date, year ended, then maybe I could take it up from there. These standards need to be, let's see, what does he say? These standards need to be revised further. They confused me the whole day. Solving console and I don't understand anything. Which standards are you talking about? Osmano in that situation. Okay. So are there any questions? Are there any other questions? Those of you on Zoom with me, you indicate by raising your hand if you have any other questions for me to pick up on real quick in that situation. I'm not solving any question. I'm only answering questions from people in that case. I'm not answering any question. How can the year ended be 31st March 2013 and the dividend is paid in 2009 and 2010? Oh, John, I really have a problem with your question. If the year ended is 2013 and dividend is paid in 2010 and 2013, how can that relate to the current year and the situation? I think maybe you need to look at the notes carefully and then you bring it to me so that if we're able to look at that. And with the same November console, the note V of that note, that's about the current account situation going up there. Kingdom had a trade receivable balance owing to Paradise 2.4. However, this does not agree with the equivalent of 800 as a result of payment of 800 made in December. We did not reflect in Kingdom's policy for cash timing difference is to adjust the parent's financial statements. So this is about reconciliation of the current account, and that is very simple. I mean, it's one of the cheapest things you can have real quick in that case. So you have the parent on one side, you have the subsidiary coming up. I'm not using their names, but you can use their names. The parent was the one selling to the subsidiary in this situation. So there will be trade receivables in the parent's category or in the parent's book, and then there will be trade payables in the subsidiary's book. So look at what the examiner said. The examiner said in the trade receivables of the parent, it's 2.4 million. So there is trade receivables of 2,400 here. But it did not agree because of cash in transit. So there is cash in transit of how much is it? Is it 800? Yeah, 800. So that will be deducted here, meaning that in their books, they are going to be having 1,600. 1,600. So actually, subsidiary has trade payables 1,600. That's how you prepare the current account. So if you go to the consolidated financial statement, if you pick trade receivables, you bring the parent, you bring the subsidiaries figure, you deduct 2,400. If you bring trade payables, you bring the parent, you bring the sub, you deduct 1,006. Then when you take the cash, you bring the parent, you bring the sub, you add the 800 to it. That is how you reconcile. Very sweet, clean, simple, straight to the point. Very sweet, clean, simple, straight to the point. So that is the idea about that. That's the idea about that. So that is for Osmanu as well in that case. What am I having here? I think there's a chart from, is it possible to solve on a question on general? Is it possible to solve questions on general? And no, I mean, like I said, like the illustration I brought up here, if there is specific debt and then the general debt, like I said here, all you do is the specific debt will come at an interest rate. The general debt stock of the company will also come at a different interest rate. So where the company is borrowing from more than one source, you need to calculate the weighted average interest rate. So if you are calculating the weighted average interest rate, you know how that is done already in that situation. So if whatever, let's say this is at 12%, whatever, this is at 11%. So you calculate the weighted average rate that has to be charged in that case, and then you use that to calculate the interest expenses. Like I said, the amount on specific is what will be capitalized. But when it comes to the general loan, if the company's general loan is 20 million, but we are using only 2 million of that for the asset, the capitalization will occur on the amount of the general loan you are using for the project. Then any other interest on the general loan will actually be treated for in the statement of profit or loss as the expenses for the year. So the key word here is how much of the general loan are we using for the project? The amount of the general loan being used for the project is what will be capitalized. Then the rest of the general loan amount will be written off in the profit or loss account in that case. But since the loan is coming from more than a source, you calculate the weighted average interest rate, and that is what you're going to be using to calculate the borrowing cost. So that is it about that one as well. That is it about that one as well. All right. Okay. So that's it about that. YouTube. No, I thought I had a comment. Morris K. Kenna. I don't know. Drop an emoji in the chat. Okay, that's fine. Hi, please. Which certification? I've answered that question. Could you please give me a WhatsApp number to send my questions PDF documents? I don't. I mean, I don't have time to solve a full question on the slide or whatever it is. So if there is any question, you can put it in the chat. If you send me a PDF file, I wouldn't have time to even look at it because my students are sending me questions that I have to look at, and I don't have time to look at any other questions apart from what my students are giving me because of my time constraint. So I wouldn't want, if you want our WhatsApp number because you want to send a question over, a full question, I wouldn't get time to solve it with you or to explain anything with you. So if there is any specific thing that you have, any specific challenge, you could bring it up and then I can solve. But looking at a whole PDF question for you, that one there, I will not get time to do that. And I have to be straight with you on that. Because my students are loading me with questions and I have to attend to them in that case. Okay. All right. Right. So I actually wanted to, start this stream at 4:30 so that we will have an extended session. But unfortunately, because of the break that I had, some small issues here that I had, we couldn't start at the time that we started. So I'm going to conclude around here today, but tomorrow 4:30 p.m. I'm going to come again on the live stream. So tomorrow you can join me again at 4:30 p.m. as we do the last preparation for the exams in that situation. So I'm going to conclude around here today. And God willing, did I say next week? God willing, tomorrow we are going to continue. So with the borrowing cost, do you use the weighted average cost to calculate the interest to be expensed on the general borrowing after capitalization? One attributable. No, the borrowing, the interest expenses to be expensed in the P&L account. For the rest of the loan, we'll be using the loan's interest rate for that general loan interest rate because that's in P&L. You are calculating the weighted average rate because you want to find out what rate do I use to capitalize on the project. But after you deal with what you are capitalizing on the project, when it comes to the loan itself, determination of the general interest loan, that one you're going to use the interest rate applicable to the loan given to you in the question. So that is what or how the treatment for that will be done. So that's how the treatment for that will be done. So I'm going to conclude around here today. And
Nhyira, come again about that explanation concerning the borrowing cost.
What I said is that he was asking whether you use the weighted average rate to calculate the interest to be taken to the P&L account. And I said no, because the general loan note has its interest. So the interest rate on the general loan is what you are going to apply to take to the P&L. The reason why you are calculating the weighted average interest rate is because you want to determine how much rate or what rate do you use to calculate the borrowing cost to be capitalized. So if the loan is 500, the general loan is 10 million, and you are using only 3 million of that for the project, then the rest of 7 million will be going into the P&L and you use the interest rate on that loan for that. But that 3 million you are bringing on board, that 3 million you will have an interest rate. But because there is a specific loan also coming in, you have to use the weighted average rate to determine the borrowing cost for the qualifying assets. That is what we mean there. So the proportion of the loan going into the capital project is what you do the weighted average on. Then the rest of the loan, you just do your normal interest rate on it, and that goes to the P&L. So,
most grateful.
Right. So that is the issue in relation to that, and that is what I'm going to do. Like, going to end around here today. God willing, tomorrow, like I said, 4:30 p.m., I'm going to come your way, and we will look at some final discussions in that situation if you have any questions. So I'll catch you again tomorrow at 4:30 p.m. You know already, for those of you who are with me on Zoom, if there are any questions you have, you can bring it up. Tomorrow, after, like I told you already in class, tomorrow, I think after 10 a.m. from church, after 10 a.m., you can call me or send me anything that you have issue with for me to comment on for you throughout in that case. So that's it. Enjoy the rest of your evening, and I'll catch you 4:30 tomorrow on the live stream for a discussion. Au revoir.